While everyone else was panic selling during the 2008 financial crisis, Warren Buffett invested $5 billion in Goldman Sachs. That single move made him over $3 billion in profit. Talk about zigging when others zag. If you're tired of checking your portfolio with the same dread you feel opening your credit card bill after vacation, you're in the right place. Today, I'm breaking down exactly how Buffett stays calm during market chaos, and how you can use these same strategies without needing billions or decades of experience. These practical approaches will transform how you view market volatility, giving you the confidence to make decisions based on logic rather than fear. The financial anxiety trap. Is it just me, or does checking your investment account during a market crash feel like watching a horror movie? You know something bad is coming, but you can't look away. That red number gets bigger and bigger while your stomach ties itself in knots. And suddenly, your finger is hovering over that sell everything button, even though deep down you know that's probably the worst move possible. Welcome to what I call the financial anxiety trap. And trust me, you're not alone in feeling this way. For our generation of young adults, money stress has become our default setting. We're navigating a financial obstacle course that previous generations simply didn't face. First, there's the student loan monster breathing down our necks, a $37,000 debt burden for the average graduate that follows you everywhere like a persistent shadow. It's a car loan without the car, or a down payment without the house. While our parents could reasonably expect their wages to grow over time, we've been stuck in economic quicksand. Adjusted for inflation, wages have barely budged in decades while housing costs have skyrocketed. When you compare the purchasing power of today's dollar with what it could buy in the 1970s, it's like we're earning monopoly money. The math just doesn't add up. Then there's the social media comparison game. That special form of torture where everyone else seems to be taking exotic vacations, buying homes, or launching successful side hustles while you're calculating if you can splurge on guacamole with your burrito. Studies show that 78% of millennials feel significant pressure to match their peers' financial success based purely on what they see online, not realizing those posts are carefully curated highlight reels, not financial reality. This anxiety intensifies when we encounter traditional financial advice. The investment world is full of experts pushing strategies that prey on our emotions rather than calm them. CNBC and financial TikTokers scream about hot stocks and crypto opportunities that you absolutely can't miss. Their message is clear: act now or get left behind. Make money fast or you're doing it wrong. This high-pressure environment leads to some truly terrible investment decisions. Remember the GameStop frenzy? By the time most everyday investors jumped on that rocket, the smart money was already heading for the exits. Or think about March 2020, when the market tanked during early COVID panic. Millions of young investors sold at the absolute bottom, locking in devastating losses, only to watch as the market recovered without them. When we're under financial stress, our brain chemistry changes dramatically. The prefrontal cortex, that rational part of your brain, gets hijacked by your amygdala, the fear center designed for immediate physical danger. This fear response that protected our ancestors from predators becomes disastrous for investing. Your body reacts to market crashes like physical threats, increased heart rate, sweaty palms, making selling everything feel like the only rational choice. Meanwhile, there's Warren Buffett, sitting in Omaha, sipping his cherry Coke, completely unfazed by market chaos. During the 2008 financial crisis, when everyone was running for the exits, Buffett was writing multi-billion-dollar checks to buy more stock. While most investors were panic selling during the COVID crash, Buffett was calmly evaluating opportunities. What does he know that the rest of us don't? Buffett is human and experiences fear too. The difference is that he has developed a psychological framework that transforms how he views market volatility. Where most see danger, he sees opportunity. Where most see chaos, he sees patterns. It's like he's playing an entirely different game than everyone else. The stats show just how badly we need Buffett's perspective. A shocking 41% of millennials report keeping more than half their investments in cash because they're too afraid to fully commit to the market. After witnessing the dot-com crash, the 2008 financial crisis, and the COVID market plunge, can you blame them? Yet this fear comes with a massive opportunity cost. That cash sitting safely in accounts is actually losing value every year due to inflation. Even more concerning, Bankrate survey found that 66% of millennials who do invest admit to making emotionally driven decisions they later regretted. The most common? Selling investments during market downturns, exactly when Buffett is most likely to be buying. Most investment advice focuses on teaching you which stocks to buy or how to read financial statements. That's helpful, but it misses the real problem. The gap between good and bad investors isn't primarily about financial knowledge. It's about psychological resilience. The most sophisticated investment strategy won't help if you panic sell the moment things get scary. What makes Buffett truly exceptional isn't his ability to analyze balance sheets, though he's certainly good at that. It's his emotional stability during times of market stress. He has famously said that temperament is more important than intellect when it comes to investing success. Anyone can learn financial ratios, but developing the ability to stay calm when everyone else is panicking, that's the real superpower. This isn't just about making more money. Financial anxiety is like a chronic condition that flares up with every market dip. It creates stress that follows you throughout your day, affecting your sleep, your relationships, and your overall well-being. Learning to manage it improves both your portfolio and your life. What Buffett has constructed over his 70-plus years of investing is a psychological framework that protects him from his own worst instincts. He doesn't try to eliminate fear. He works with it, understands it, and ultimately uses it to his advantage. The good news is that while none of us will match Buffett's track record, we can adopt his mindset. That's what makes Buffett's approach so powerful for everyday investors like us. We don't need his billions or his decades of experience to benefit from his psychological framework. We just need to understand how he thinks about markets, risk, and volatility, and then build habits that reinforce those thought patterns until they become second nature. Rule number 1, never lose money. While everyone's searching for investments that'll double or triple their money, Warren Buffett sits quietly focused on something that seems almost too simple, not losing what he already has. His famous rule number 1 of investing: never lose money. And rule number 2, never forget rule number 1. Might sound like obvious advice, but there's profound wisdom hiding in this straightforward principle. Think about your own investing approach for a second. When you're researching stocks or funds, what's the first thing you look for? Most of us immediately check the potential upside. This could go up 20%. Or this startup might be the next unicorn. We're programmed to chase gains, constantly looking for the next big winner. Financial media reinforces this mindset with endless headlines about top 10 stocks ready to explode, or the next 10x winner you're missing. Buffett flips this approach completely upside down. While we're fixated on potential gains, he's obsessively calculating potential losses. It's like he's playing an entirely different game than everyone else in the market. This seemingly backward approach is based on brutal mathematical reality. When Buffett talks about never losing money, he's acknowledging something most investors ignore: the devastating asymmetry of losses and gains. Here's the mathematical truth. If your $10,000 investment drops by 50%, you're left with $5,000. To get back to where you started, you need a 100% gain. The equation gets worse with larger losses. A 75% loss requires a 300% gain to recover. It's like standing on one side of a widening canyon. Each additional foot of market decline forces you to jump exponentially farther to reach the other side. During the late 1990s dot-com bubble, everyone thought Buffett had lost his touch. Tech stocks soared daily while Buffett sat on the sidelines, refusing to participate in what seemed like easy money. People mocked him as an old-school investor who didn't get the new economy. Fast forward to 2001 to 2002. Those high-flying tech companies crashed 80 to 90%, and many disappeared entirely. Meanwhile, Buffett's portfolio remained largely intact, allowing him to buy quality companies at fire-sale prices when everyone else was trying to recover from devastating losses. Buffett implements his never lose money rule primarily through the margin of safety concept, an investing cushion that protects against unforeseen problems. Think of it like driving across a bridge with a 10,000-pound weight limit. You wouldn't load your truck with exactly 10,000 pounds. You'd stay well below that limit to account for unexpected conditions like strong winds or structural weaknesses. In investing terms, Buffett looks for a significant gap between a company's price, what you pay, and its intrinsic value, what it's actually worth. The wider this gap, the bigger your margin of safety. This creates a buffer against mistakes in your analysis, unexpected market movements, or company-specific problems. When analyzing Coca-Cola in 1988, Buffett saw beyond current financials to recognize extraordinary brand power, consistent cash flow, and global growth potential. He calculated that Coca-Cola's intrinsic value significantly exceeded its market price. Some reports suggest he applied a margin of safety around 50%, meaning he believed the company was worth potentially twice what he paid. The formula is straightforward. Margin of safety equals 1. Current stock price / intrinsic value per share. While ideal margins vary by risk tolerance, Buffett typically seeks margins of at least 10 to 20%, often higher for less predictable businesses. This approach contrasts sharply with today's FOMO-driven investing culture. Social media feeds showcase people buying the latest meme stocks or cryptocurrencies after they've already skyrocketed. There's enormous pressure to chase whatever's moving up fastest, regardless of underlying value. This creates an environment where people buy assets with zero margin of safety, often paying premiums well above reasonable valuations. Buffett's concept proves particularly powerful during market corrections. When panic causes investors to dump quality companies at any price, Buffett steps in with confidence because he knows the intrinsic value hasn't changed nearly as much as the price. This discipline has enabled some of his best investments during market downturns. Consider American Express after the Salad Oil scandal in the 1960s. When fraud involving salad oil inventory caused Amex stock to plummet, Buffett recognized that the company's fundamental business, its brand and customer loyalty, remained strong despite the temporary setback. He invested heavily while others fled, acquiring a significant stake at bargain prices. This wasn't gambling, but a calculated decision based on a suddenly enormous margin of safety between price and value. Buffett's never-lose-money philosophy creates a psychological framework that transforms how you experience market volatility. When you prioritize capital preservation, market dips become potential opportunities rather than sources of anxiety. You actually get excited when solid companies go on sale, instead of panicking when your portfolio temporarily declines. The rule doesn't mean avoiding all losses. That's impossible, and even Buffett has had losing investments. It means approaching each investment decision with a capital protection mindset first. It's about structuring investments where the potential downside is limited while the upside remains substantial. This approach demands discipline and patience. It means sitting out overvalued markets or sectors, even when everyone around you is making money. It means waiting, sometimes for years, for the right opportunity at the right price. This patience has helped Buffett avoid the worst bubbles of recent decades, from tech in the late 90s to real estate in the mid-2000s. The power of knowing what you don't know. Buffett's avoidance of tech bubbles wasn't just luck or old-school thinking. It was the result of a mental framework that's completely opposite to what your financial advisor probably tells you. Instead of diversifying across every sector like you're supposed to, Buffett draws a circle around what he truly understands and refuses to step outside it, even when missing apparent golden opportunities. This concept is what Buffett calls his circle of competence, possibly the most powerful mental model in his investment arsenal. Think of it like a spotlight in a dark room. Where the light shines, you can see clearly and make confident decisions. The temptation is to venture into the darkness where undiscovered treasures might be. But Buffett suggests you're better off making the spotlight brighter and slightly wider over time, rather than stumbling around in the dark. As he puts it, the size of your circle of competence doesn't really matter. Knowing its boundaries, however, is vital. Most financial advisors will tell you to spread your money across all kinds of industries: tech, healthcare, energy, consumer goods. The idea is that diversification protects you from sector-specific downturns. Sounds smart, right? But Buffett takes the opposite approach. He believes that trying to understand everything means you'll understand nothing deeply enough to make smart decisions. Remember the late 90s when internet companies were skyrocketing? Everyone was getting rich off companies with .com in their names, many of which had never turned a profit. While Wall Street analysts were throwing around terms like new paradigm and eyeballs over earnings, Buffett watched from the sidelines. People called him a dinosaur who didn't get technology. Financial magazines questioned if his approach was outdated in the new digital economy. When the bubble burst in 2000, many of those high-flying tech stocks crashed 80 to 90%. Companies worth billions on. paper disappeared entirely. Meanwhile, Buffett's portfolio remained intact. What looked like stubborn reluctance was actually disciplined self-awareness. He avoided tech because he knew he couldn't predict which technologies would win in the long run. Buffett decides if something falls within his circle of competence using the newspaper test. If you can't explain how a business makes money in a simple paragraph, like you're writing a newspaper article, you probably shouldn't invest in it. It's about whether you understand the complexity, not whether the business itself is complex. Your personal experiences create mini circles of competence that most other investors don't share. A nurse might spot a promising medical device company before Wall Street does. A plumber might notice which brands rarely need repairs. Your job, hobbies, and daily routines give you unique insights if you pay attention to them. This self-awareness about limitations leads to another powerful tool in Buffett's arsenal, the too hard box. This isn't metaphorical. Buffett actually has a box on his desk where he puts investment ideas that are too complicated or outside his expertise. As Charlie Munger simply puts it, we have 3 boxes, in, out, and too hard. Consider how many everyday investors lost money in cryptocurrency without understanding blockchain technology. Take Lisa, a successful dentist who invested heavily in a biotech startup because her neighbor, who worked there, was enthusiastic about their new drug. When clinical trials failed, she lost 80% of her investment. Had she applied Buffett's circle of competence, she might have realized biotech investment requires specialized knowledge she didn't possess. The too hard box acknowledges that some investments, no matter how profitable they might seem, aren't worth the risk if you can't understand them. What makes this concept powerful is that it's about current limitations, not permanent ones. Take Apple. For decades, Buffett avoided technology stocks. Only in 2016, 9 years after the iPhone's introduction, did Buffett finally invest. Why? Apple had evolved from a pure technology company into a consumer brand with predictable revenues, massive customer loyalty, and a powerful ecosystem, qualities Buffett understood well from his experiences with companies like Coca-Cola. The Apple investment wasn't Buffett abandoning his circle of competence. It was recognizing that Apple had entered his circle. The company had transformed from a tech innovator to a consumer brand with predictable cash flows. Your circle can grow as you learn more or as businesses themselves evolve. Knowing your limitations is actually a superpower in investing. The worst investment mistakes happen when someone thinks they understand something they really don't. As Buffett says, risk comes from not knowing what you're doing. By staying within your circle of competence, you're limiting your risk of catastrophic mistakes. Buffett's investment in Dexter Shoe Company illustrates this point. In 1993, Buffett acquired Dexter for $433 million in Berkshire Hathaway stock. He later called it a $3.5 billion blunder because he misjudged how vulnerable American shoe manufacturing was to foreign competition. The mistake: he stepped outside his circle by failing to recognize how global manufacturing trends would impact the business. The beauty of this approach is that it doesn't require you to be the smartest person in the room. You don't need to understand everything, just some things deeply. Buffett spends most of his day reading, expanding his knowledge about industries he already understands, focusing on depth rather than breadth. For everyday investors, this means focusing on learning more about industries you already have exposure to through your work or interests. Your existing knowledge can be your edge if you stay within its boundaries. Even successful investments require periodic reassessment. In 2023 and 2024, Buffett sold portions of his Apple holdings despite the investment's tremendous success. This wasn't because he suddenly disliked Apple. It was partly to manage Berkshire's cash position and tax considerations. When you invest within your circle of competence, you gain something invaluable: conviction. When markets crash and everyone is panicking, your deep understanding gives you the confidence to hold on or even buy more of the businesses you understand. The forever mindset. This conviction isn't just a mental state. It's the foundation for Warren Buffett's most powerful advantage, his legendary forever mindset. While today's investor can barely commit to a relationship with a stock longer than a summer fling, Buffett approaches investing like a marriage proposal, complete with the till death do us part commitment. His favorite holding period isn't measured in days or months, it's literally forever. And this completely changes the game. Think about how Wall Street operates today. Analysts obsess over Quarterly earnings reports like they're the season finale of their favorite Netflix show. Miss expectations by a penny? The stock gets punished. Beat them by a few cents? Pop the champagne. This short-term fixation creates a bizarre casino atmosphere where actual business performance takes a back seat to whether a company hit some arbitrary 3-month target. Meanwhile, Buffett's sitting in Omaha, probably enjoying a cherry Coke, completely unbothered by this quarterly circus. He's playing an entirely different game with a completely different scorecard. While day traders frantically check their phones every 5 minutes, Buffett's thinking about where Coca-Cola will be in 2035, not next Tuesday. Speaking of Coca-Cola, this investment perfectly showcases the power of Buffett's forever mindset. Back in 1988, Buffett started building what would become Berkshire Hathaway's massive position in the beverage giant. Fast forward to today, and he's still holding those shares more than 35 years later. He's now Coca-Cola's largest shareholder, and this decision to buy and hold has transformed into one of Berkshire's most legendary investments. What made Buffett invest in Coca-Cola was his deep understanding of the brand's enduring value and unparalleled customer loyalty. He recognized the simplicity of the beverage industry and Coca-Cola's strong global presence. More importantly, he saw that Coca-Cola's timeless appeal to consumers would help it overcome any short-term market hiccups or business challenges. When Buffett looks at a company like Coca-Cola, he sees a piece of a business with what he calls an economic moat, a sustainable competitive advantage that protects it from competitors. This understanding allowed him to see past market noise and focus on the company's true value over decades, not days. The math behind this patience works like a snowball rolling downhill. When most people think about investing returns, they think linearly. 10% a year means 10% more money next year. But compound interest creates an exponential growth pattern. Like a snowball that starts small but picks up more snow with each revolution, your money grows faster as time passes. The initial $10,000 might grow to $11,000 after 1 year, but after 30 years at the same rate, you'd have over $174,000, a 17-fold increase. That's the mathematical inevitability that Buffett harnesses through his forever mindset. Staying invested is like aging a fine wine. While an impatient investor might uncork the bottle too early and miss its peak flavor, the patient investor allows time to work its magic, transforming something ordinary into something extraordinary. Yet most investors today can barely sit still. The average stock holding period has plummeted to just 5.5 months. Less time than it takes to grow a tomato plant or complete a semester of college. This short-term mindset creates a hyperactive market environment where people constantly buy and sell, racking up transaction costs, triggering taxable events, and missing the compounding magic. When everyone focuses on the next quarter, they miss decade-long trends that create real wealth. It's like trying to predict the climate by looking at today's weather forecast. You might guess right occasionally, but you'll miss the bigger patterns that matter. Buffett's approach to investing is about buying a piece of a business. This perspective changes everything. When you see yourself as a business owner rather than a stock trader, you naturally take a longer view. You start caring about competitive position, management quality, and long-term growth prospects instead of daily price fluctuations. This business owner mindset explains why Buffett largely ignores quarterly earnings reports. He knows they're just snapshots, often manipulated ones, of a much longer journey. Instead, he focuses on the 5 to 10-year business outlook. Can this company maintain its competitive advantage? Will its products remain relevant? Does management allocate capital intelligently? These questions matter far more than whether they beat this quarter's earnings by a few pennies. One powerful benefit of Buffett's forever mindset is how it transforms his experience of market volatility. When the market crashes, most investors panic because they have no idea what their stocks are actually worth. They're trading paper, not owning businesses. But Buffett sees market crashes as extraordinary opportunities to buy great businesses at discount prices. It's like walking into your favorite store and finding everything suddenly 40% off for no good reason. You wouldn't panic. You'd grab your wallet. This approach to market downturns only works because his forever mindset gives him perspective to see the temporary nature of market panic. The forever mindset creates a sustainable investment approach that reduces stress. When you focus on decades instead of days, you can tune out constant market noise. You don't need to check your portfolio obsessively. or worry about timing the market. You simply focus on owning great businesses for the long run. This brings us to perhaps the most underappreciated aspect of Buffett's approach. It's psychologically sustainable. Most investment strategies fail not because they're mathematically flawed, but because humans can't stick with them emotionally. We get scared, greedy, or bored. But the forever mindset, once truly internalized, creates a calm, emotional discipline, the real secret sauce. The psychological sustainability of Buffett's approach hinges on something far more rare than financial intelligence. It's his unshakable emotional discipline during market chaos. When everyone else is losing their minds during market crashes, Buffett turns to an unlikely source of strength. A poem written in 1895 that completely reframes how he experiences market volatility. You know that sinking feeling in your stomach when you check your investment app and see everything glowing bright red? That emotional reaction creates a powerful physical response as your brain floods with stress hormones. This instinctive reaction can override your rational investment plans in seconds. During market downturns, Buffett frequently turns to Rudyard Kipling's 1895 poem, If, as his mental anchor. The opening line, "If you can keep your head when all about you are losing theirs," perfectly captures Buffett's approach to market turbulence. The poem's message about maintaining composure when others panic, trusting yourself despite doubts, and having the patience to wait without growing tired serves as an emotional stabilizer for him during financial storms. This is where most of us mess up big time. We think investing success comes down to picking the right stocks or timing the market perfectly. The greatest threat to your investment returns isn't choosing the wrong companies. It's your own emotional reactions to market movements. Research consistently shows that the average investor trails market performance by a staggering 4 to 5% annually. That's because people make decisions with their emotions instead of their rational minds. When prices fall, fear takes over, and they sell at the worst possible moment. When prices soar, greed kicks in, and they pile in at the peak. It's a recipe for financial disaster that plays out cycle after cycle. This is exactly where Warren Buffett separates himself from almost every other investor on the planet. While his investment principles are important, his emotional discipline is the true superpower that's driven his decades of market-beating returns. The poem reminds Buffett to detach from the emotional contagion that sweeps through markets during periods of extreme volatility. When other investors are driven by fear, Buffett stays centered in rationality. This emotional discipline manifests in his famous advice to be fearful when others are greedy and greedy when others are fearful. In October 2008, at the height of the financial crisis, Buffett published an op-ed in the New York Times titled, "By American, I Am." While panic had gripped markets and many investors were liquidating their portfolios at devastating losses, Buffett announced he was moving his personal portfolio from government bonds to U.S. stocks. The market wouldn't bottom for several more months, but Buffett recognized the extreme fear had created extraordinary buying opportunities. Another powerful mental model Buffett uses to maintain emotional discipline is his concept of Mr. Market, an idea he borrowed from his mentor Benjamin Graham. Instead of seeing the market as an intimidating, all-knowing force, Buffett imagines it as a manic-depressive business partner who shows up daily offering to buy your shares or sell you his. Some days, Mr. Market arrives in a fantastic mood and offers absurdly high prices for your stocks. Other days, he's deeply depressed and willing to sell you his ownership stakes for pennies on the dollar. The key insight is that you're under no obligation to trade with him. You can simply observe his mood swings and only transact when he offers you favorable terms. This personification helps Buffett detach emotionally from market movements. He doesn't see volatility as threatening or confusing. He sees it as creating opportunities. When Mr. Market is feeling pessimistic and offering bargain prices, Buffett is eager to buy. When Mr. Market is overly optimistic and offering premium prices, Buffett is content to sell or simply wait. What's particularly fascinating about this approach is how it completely inverts the normal emotional experience of investing. While most people feel anxiety during market downturns, Buffett feels excitement at the potential bargains. While most feel euphoria during booming markets, Buffett often grows cautious, knowing Mr. Market might be getting ahead of himself. This emotional inversion is key to Buffett's success, but it's also the hardest part of his approach to replicate. Anyone can understand his investment principles intellectually, But maintaining emotional discipline when your portfolio is dropping 30% or more is an entirely different challenge. The good news is that emotional discipline isn't some innate trait that Buffett was born with. It's a skill developed through having a sound investment framework that gives you confidence during chaos. When you thoroughly understand the businesses you own, have purchased them with a margin of safety, and are thinking in decades rather than quarters, market volatility becomes much less frightening. Think of emotional discipline like a muscle that gets stronger with each market cycle you endure. The first major drop might be terrifying, but after you've weathered several and seen markets eventually recover, each subsequent decline becomes easier to handle emotionally. You develop the confidence to stay the course or even invest more when opportunities arise. For everyday investors, building this emotional discipline starts with honest self-assessment. How did you react during the last market correction? Did you panic sell? Did you hesitate to invest when great companies were suddenly on sale? Understanding your emotional triggers is the first step toward controlling them. Second, create an investment policy statement before the next market crash. Write down your investment principles, your time horizon, and exactly how you plan to respond to market drops of various magnitudes. Having this written guide can help override emotional impulses when markets get turbulent. Finally, consider limiting how often you check your portfolio. Studies show that investors who check their accounts daily or weekly make far more emotional decisions than those who review their investments monthly or quarterly. The less you expose yourself to the market's daily mood swings, the easier it is to maintain your emotional equilibrium. Finding companies with unfair advantages. Instead of tracking every twist and turn in the stock market, Buffett spends his time hunting for a special kind of business, those with built-in protection against competition. Think about it. Why can't any startup just copy Apple's success or steal Coca-Cola's customers overnight? The answer lies in what Buffett calls economic moats, and they're the real reason some companies dominate their industries for decades while others flame out after a few good years. Economic moats function like medieval castle defenses, creating sustainable competitive advantages that protect a company's profits and market share for the long haul. While most investors chase headline-making stocks, Buffett quietly evaluates what makes a business untouchable to competitors. This approach fundamentally contradicts how most people invest today. Scroll through investing subreddits or finance TikTok, and you'll see everyone hyping companies because they're disrupting industries or growing rapidly. Buffett, however, seeks businesses that resist disruption, companies with advantages so powerful that competitors struggle to steal their customers. Buffett identifies 5 specific types of economic moats, each creating a distinct competitive fortress. Brand power. Consider your local coffee shop that maintains loyal customers despite a chain opening nearby. This dynamic works on a massive scale with companies like Coca-Cola, whose red and white logo is instantly recognized worldwide. Their global distribution network ensures the same taste whether you're in New York or Nepal, allowing them to charge premium prices for flavored sugar water, and customers gladly pay it. High switching costs. Apple excels here by creating an ecosystem where iPhone, MacBook, Apple Watch, and AirPods work together seamlessly. Switching to Android means learning new systems, losing message history, and abandoning paid apps. These significant barriers lead customers to accept premium prices rather than leave the ecosystem. Network effects. Services become more valuable as user numbers increase. American Express demonstrates this perfectly. Merchants accept Amex because wealthy customers use it, and those customers use it because so many merchants accept it. This self-reinforcing cycle creates a barrier that new competitors struggle to overcome. Cost advantage. Geico has mastered this through its direct-to-consumer insurance model. By eliminating insurance agents and selling directly to customers, Geico maintains significantly lower costs than traditional insurers. This enables better pricing while preserving healthy profit margins, an advantage that agent-based insurance companies cannot match without completely restructuring their operations. Regulatory protection. VeriSign maintains a government-approved monopoly as the sole authorized registry for .com and .net domain names. This regulatory advantage prevents competitors from entering without regulatory changes, allowing VeriSign to generate consistent earnings that rivals simply cannot access. The brilliance of Buffett's approach is that these moats appear in your daily life. Pay attention to products you purchase despite cheaper alternatives. Notice which subscriptions would be inconvenient to cancel. Which services do all your friends use, making switching impossible? These behaviors reveal economic moats in action. Think about why you buy that specific cereal brand when the generic version costs half as much. Or why you haven't switched cell phone carriers despite competitors' tempting offers. Companies behind these products have built moats that keep you returning, exactly what Buffett seeks. These moats create pricing power, the ability to raise prices without losing customers. When your favorite coffee shop raises prices by 50 cents, you likely stay loyal. That pricing power is crucial for long-term profitability, especially during inflation. Companies without moats engage in constant price wars that crush margins, while moat-protected businesses can pass cost increases to customers who barely notice. Consider Buffett's American Express investment following the 1960s salad oil scandal. While others worried about immediate troubles, Buffett recognized that Amex's brand and customer loyalty remained intact. Their traveler's check and charge card businesses continued thriving because customers trusted the brand. This moat enabled recovery and eventual growth, demonstrating how strong competitive advantages help businesses weather serious setbacks. Identifying these moats early helps Buffett find companies that compound value for decades. His Coca-Cola investment in the late 80s wasn't just purchasing a popular soda company. He acquired an unstoppable brand with global reach and intensely loyal customers. That moat has allowed Coca-Cola to consistently raise prices while maintaining market share, delivering decades of reliable profits. Even Buffett's recent investments in Occidental Petroleum and Constellation brands reflect this pattern. Companies with strong market positions and consistent earnings that competitors struggle to match. These moves demonstrate Buffett's unchanged strategy of pursuing businesses with unbreachable competitive advantages. Economic moats can evolve over time. SiriusXM, another Buffett holding, has seen its moat weakened by increasing competition from music streaming services. This highlights an important reality. Moats aren't permanent. Technology changes, consumer preferences shift, and regulations evolve. That's why Buffett doesn't simply buy and forget. He continuously evaluates whether competitive advantages remain intact. This explains why economic moats bridge Buffett's margin of safety principle and his forever holding period. He'll hold stocks indefinitely, but only while their moats remain strong. When competitive advantages erode, Buffett reassesses. A wonderful business today with a drying moat won't remain wonderful tomorrow. The management test. A fortress-like moat might protect a business from outside competitors, but what about the threats from within? Remember when Buffett said, "It takes 20 years to build a reputation and 5 minutes to ruin it." That's why his next investing filter is all about the humans behind the business. Because even the strongest company can be destroyed overnight by leaders who don't pass what Buffett calls his newspaper test. And this test has saved him from some of the biggest corporate disasters of our lifetime. While most Wall Street analysts are busy crunching numbers and obsessing over quarterly earnings forecasts, Buffett is thinking about something completely different. He's wondering whether he'd trust the CEO to date his daughter or manage his grandmother's retirement fund. Seriously, when Buffett evaluates a company, he looks beyond balance sheets to assess the character of the people running the show. This approach to management evaluation creates a massive blind spot for most investors. Think about it. How many times have you researched a stock by checking revenue growth, profit margins, and debt levels? Now, how many times have you researched the CEO's character? Most of us treat companies like they're just numbers on a spreadsheet rather than organizations run by actual humans who make thousands of decisions that never appear in financial statements. For Buffett, evaluating management is like choosing a captain for a ship crossing treacherous waters. Their character will determine whether everyone arrives safely at their destination. His assessment starts with integrity, his non-negotiable first requirement. He famously says that if someone lacks integrity, their intelligence and energy will actually make them more dangerous, not less. That's because smart, energetic people without moral compasses can cause exponentially more damage. When Buffett looks at management, he watches for leaders who admit mistakes openly, take responsibility rather than shifting blame, and speak plainly rather than hiding behind corporate jargon. The second trait Buffett searches for is owner orientation. Leaders who think and act like shareholders because they are significant shareholders. These executives treat company money as if it were coming directly from their own pockets. They avoid wasteful spending on flashy corporate headquarters, excessive perks, or ego-driven acquisitions. Instead, they focus relentlessly on maximizing long-term value, even when it means making unpopular short-term decisions. The third quality Buffett prizes is genuine passion for the business itself, beyond the compensation package. He specifically looks for CEOs who are already wealthy, but still work insanely hard because they're driven by something deeper than money. They genuinely love building their business, creating resilience during tough times, and preventing the kind of corner cutting that happens when executives are just marking time until retirement. The story of Rose Blumkin, Mrs. B, perfectly illustrates what Buffett values in business leaders. When Buffett decided to buy 80% of Nebraska Furniture Mart in 1983, he did it with a handshake, no lengthy contracts or legal teams. His trust was based entirely on his assessment of Mrs. B's character and business acumen. What made her so impressive wasn't formal education, but her relentless work ethic and deep understanding of her business. Even at 95 years old, when most people would be long retired, she launched a new furniture venture, demonstrating the kind of passion that Buffett finds irresistible in business leaders. This focus on human factors gives Buffett insights that purely quantitative investors completely miss. While financial metrics can be manipulated quarter to quarter, character reveals itself over time through consistent actions and decisions that either build or destroy value. Buffett's approach also involves spotting red flags that signal trouble ahead. One major warning sign is excessive compensation, especially when executives are paid richly regardless of company performance. He's particularly suspicious of complex compensation packages with multiple performance metrics that seem designed to ensure bonuses regardless of actual shareholder returns. Another red flag is empire building. CEOs who make frequent acquisitions to grow company size rather than shareholder value. These executives often care more about having a bigger company to manage, which typically means higher pay and status for them, than about whether these acquisitions actually make sense financially. The third warning sign is leaders who consistently blame external factors for poor results. If the economy, weather, government regulations, or competitors are always responsible for problems, but management takes full credit for successes, that's a character issue. Great leaders acknowledge failures, take responsibility, and focus on solutions rather than excuses. Buffett's management evaluation process is particularly effective because he's looking for qualities that aren't easily faked. He observes how executives handle adversity, how they treat employees when they think no one important is watching, and whether they do what they promise. He's also known to read years of shareholder letters and public statements to check for consistency and honesty. This management assessment isn't just about finding superstar CEOs. It's equally about avoiding disasters. Buffett has sidestepped numerous accounting scandals by spotting integrity issues early. When something doesn't feel right about management, Buffett simply walks away. As he puts it, there's never just one cockroach in the kitchen. The first small sign of dishonesty often indicates much bigger problems hiding beneath the surface. Here's where Buffett's approach gives everyday investors a real advantage. While you might not get to personally interview CEOs like he does, you can still evaluate management through their actions. Do they consistently deliver on promises? Do they speak plainly about challenges? Do they own meaningful amounts of company stock and rarely sell shares? Do they allocate capital wisely rather than chasing growth at any cost? These behaviors are visible to anyone paying attention. The quality of management often makes the difference between good businesses becoming great investments or disappointing ones. A mediocre business with exceptional management frequently outperforms a great business with mediocre leadership over the long run. By paying attention to the humans behind the business, not just the business model, Buffett gains insights that purely quantitative investors completely miss. The Apple case study, principles in action. Beyond just analyzing management teams, Buffett's greatest investments reveal how all his principles work together in perfect harmony. Ever wonder why the man who once joked he used a flip phone and avoided tech investments suddenly poured billions into Apple? This apparent contradiction actually demonstrates Buffett's genius and contains the exact blueprint you need to spot your own potential multi-baggers hiding in plain sight. Let's rewind to late 2016. While tech analysts claimed Apple had lost its innovative edge after Steve Jobs, Buffett quietly began building what would become Berkshire Hathaway's largest position ever. His initial $1 billion investment marked the beginning of a remarkable shift in strategy. For decades, Buffett had deliberately steered clear of technology stocks. He proudly declared he didn't understand technology companies and operated strictly within his circle of competence. Yet suddenly, he was making his biggest bet ever on what most considered the ultimate tech giant. The explanation? Buffett applied the same timeless principles he always had. He simply saw Apple differently than others did. While Wall Street labeled Apple as a tech company, Buffett recognized it as a consumer brand with extraordinary customer loyalty and pricing power. This insight placed Apple squarely within his domain of expertise. Consider your own relationship with Apple products. When you purchase an iPhone, are you primarily making a technology decision or a lifestyle choice? Apple had transformed from a computer manufacturer into a status symbol and ecosystem that people emotionally connect with. Buffett spotted this transformation, while others focused on product specifications and quarterly unit sales. This consumer-focused perspective revealed Apple's economic moat with clarity. The ecosystem Apple built, where devices work seamlessly together, creates substantial switching costs. Once in the Apple universe, leaving becomes increasingly difficult with each additional product. This stickiness gives Apple remarkable pricing power, enabling premium prices that customers willingly pay repeatedly. Buffett's entry point showed equal brilliance. He began purchasing when market sentiment had soured and Apple traded at just 10 to 11 times earnings, a bargain for a company with such dominant market position. While others worried about slowing iPhone sales or lack of new products, Buffett concentrated on the strong balance sheet and massive cash flow generation. His margin of safety principle came alive here. Apple's enormous cash reserves provided downside protection, while its loyal customer base and growing services revenue offered multiple paths to future growth. Buffett saw a business with numerous ways to win and limited ways to permanently lose. Equally impressive was Buffett's emotional discipline throughout this investment journey. During Apple's periodic 20 to 30% drops, Buffett maintained composure, often buying more. When Apple fell nearly 40% in late 2018 amid broader market concerns, he didn't panic. He understood short-term fluctuations represented noise, not signal. This steady approach allowed Berkshire to build a position that grew to over $150 billion by 2023, a 285% return on his original investment. For small investors, this demonstrates the power of identifying quality businesses and holding through volatility rather than chasing short-term performance. Starting in late 2023 through early 2024, Buffett reduced Berkshire's Apple position by about 56%, selling over 515 million shares. This wasn't abandoning his thesis, but applying the same disciplined principles. Apple had grown to represent over 40% of Berkshire's stock portfolio, an enormous concentration even by Buffett's standards. By trimming, he managed portfolio risk while creating tax benefits for Berkshire. The selling represented sound portfolio management, not a rejection of Apple's business model. Buffett explained these sales would benefit the company's tax position and help manage Berkshire's substantial cash during uncertain market conditions. Even after this significant reduction, Apple remains among Berkshire's largest holdings, just at a more balanced level. The complete Apple story, from initial purchase through the build-up and recent trimming, showcases Buffett's investment principles in action. He recognized a great business with durable competitive advantages within his circle of competence. He bought at a reasonable price with a margin of safety, held through market volatility with patience, and showed discipline to rebalance when the position grew too large. Buffett's genius lies in consistently applying timeless principles across different market environments. He doesn't need to be right about every short-term move. He identifies businesses with long-term value and structural advantages, then lets time work its magic. What can we learn from Buffett's Apple investment? First, look beyond surface-level classifications. Apple wasn't valuable because it made phones. It was valuable through creating an ecosystem customers couldn't easily abandon. Second, develop courage to challenge conventional wisdom when your analysis supports it. When Buffett first bought Apple, many believed its best days were behind it. He saw past this pessimism to the enduring value of the brand. Third, remember that buying is just the beginning. Buffett's gains came from his initial purchase, continued buying during weakness, and patience during difficult periods. His discipline to trim when the position grew.
Buffett for beginners. Starting small. While we've been geeking out over Buffett's billion-dollar Apple investment and his genius stock-picking strategies, here's the mind-blowing truth. The world's greatest stock picker actually tells most people not to pick individual stocks at all. That's right. The same investing legend who made his fortune analyzing companies one by one has completely different advice for everyday investors like us. And honestly, it might be the smartest financial wisdom he's ever shared. So what's Buffett's recommendation for regular folks? Consistently buy low-cost S&P 500 index funds. That's it. No complex spreadsheets, no poring over annual reports until 2 a.m., no watching CNBC with 3 screens of stock charts. Just regularly investing in a simple fund that tracks the overall market. The contrast is striking. Buffett spends his days navigating the complex maze of individual stock selection, analyzing financial statements and competitive advantages, while suggesting we take the elevator straight to the top through index funds. It's like he's scaling a mountain using technical climbing gear while pointing the rest of us toward the convenient ski lift that reaches the same summit. Why would the master of finding undervalued companies tell the rest of us not to even try? Buffett understands something profound about human psychology and investing reality. Most of us simply don't have the time, knowledge, emotional discipline, or desire to properly analyze companies the way he does. We have jobs, relationships, hobbies, and a million other things competing for our attention. Buffett's entire life has been dedicated to investing, something most of us can't replicate. When you look closer, Buffett's index fund advice actually incorporates all his core investment principles we've been discussing. By investing in index funds, you're automatically taking a long-term perspective, principle number 1, since these funds are designed to be held for decades. You're building in emotional discipline, principle number 2, because the simplicity of the strategy makes it easier to stay the course during market chaos rather than panic selling. And you're drastically reducing the risk of catastrophic mistakes, principle number 3, by avoiding the pitfalls of picking the wrong individual companies. You can apply Buffett's margin of safety concept through dollar-cost averaging. Instead of trying to time the market, you invest a fixed amount regularly, which naturally means you buy more shares when prices are low and fewer when they're high. During market crashes, you can even ramp up your contributions if you have extra cash, essentially getting the entire market on sale. What if you still want to develop your investment skills beyond index funds? Buffett suggests starting to build your circle of competence by paying attention to the products and services you already use and understand. That coffee shop you visit 3 times a week? That app you can't live without? These companies might be hiding in plain sight as potential investments once you've got the basics down. Start with what you know, Buffett suggests. If you work in healthcare, you likely understand certain medical companies better than the average person. If you're a tech whiz, you might have insights into software companies that others miss. Your everyday experiences give you a natural edge in specific areas, a foundation you can build on. Even more importantly, Buffett emphasizes investing in yourself first. The best investment you can make is in your own abilities, he often says. Developing your skills, furthering your education, and improving your earning potential will likely generate far better returns than any stock pick, especially early in your career. Increasing your salary by $10,000 could be worth more than years of investment returns on a small portfolio. Getting started has never been easier. Today's investment apps let you begin with small amounts through fractional shares and automatic investing. You can implement Buffett's strategy with minimal starting capital, democratizing investing in a way that wasn't possible even a decade ago. What's powerful about starting with index funds is that they give you time to learn while your money grows. You can begin studying individual companies without the pressure of immediate performance. You can practice analyzing businesses using play money while the bulk of your savings follows Buffett's safer path, like having training wheels while you learn to balance. Buffett's sincerity about this approach is demonstrated in his own estate planning. In his will, he's directed that 90% of his wife's inheritance should be invested in a low-cost S&P 500 index fund, with the remaining 10% in short-term government bonds. The greatest stock picker of all time is leaving instructions for his own family to mostly avoid picking individual stocks. This isn't theoretical advice. Buffett has consistently championed index funds for decades. He famously won a $1 million bet against hedge fund managers, arguing that a simple S&P 500 index fund would outperform a collection of hedge funds over 10 years. The index fund delivered nearly triple the returns after fees. This approach is quintessential Buffett, focusing on what works reliably over the long term rather than what's flashy. Index funds capture the growth of American business as a whole, automatically adjust as the economy evolves, and keep costs incredibly low, often charging less than 0.1% annually compared to the 1 to 2% many actively managed funds charge. For beginners especially, this creates a powerful foundation. While you're learning about business analysis, your money is already working for you in a sensible way. You're avoiding costly mistakes while still participating in market growth and developing patience, investing's most valuable skill. The beauty of Buffett's beginner strategy acknowledges a reality many investment gurus won't admit. Most people aren't cut out to be full-time stock pickers, nor should they be. You can be incredibly successful and financially secure without ever analyzing a balance sheet. The index fund approach lets you focus on what you're actually good at while still building wealth steadily over time. The patience paradox. Speaking of building wealth steadily over time, there's actually a fascinating contradiction at the heart of Buffett's success that most financial gurus completely miss. While everyone's chasing complex trading algorithms or hunting for the next crypto moonshot, Buffett's superpower isn't his brain. It's his almost superhuman ability to wait patiently when literally everyone else is freaking out. I call this the patience paradox, and it's probably the most underrated aspect of Buffett's entire investment approach. The paradox is this: Buffett's strategy is simple enough that a fifth grader could understand it, yet so psychologically difficult that Wall Street's brightest minds can't consistently stick with it. The secret ingredient is the willingness to wait in a world obsessed with instant results. This makes perfect sense when you look at what psychology research tells us about financial decision-making. Studies consistently show that people with higher patience levels make more rational investment choices, especially during market chaos. Meanwhile, impatient investors tend to make emotional decisions, like panic selling during downturns or chasing trends after they've already peaked. The science is crystal clear: patience directly translates to better investment outcomes. Buffett himself put it perfectly when he said, "The stock market is a device for transferring money from the impatient to the patient." This statement forms the practical foundation of his entire philosophy. When markets tank and everyone's selling in a panic, patient investors like Buffett are buying quality businesses at discount prices. When markets are soaring and everyone's throwing money at overpriced stocks, patient investors are sitting on their hands, waiting for better opportunities. What makes this so challenging is that our entire culture now revolves around instant gratification. We get mad when our Amazon packages don't arrive within 48 hours. We switch to a different YouTube video if the intro takes more than 10 seconds. We can order food, transportation, entertainment, and basically anything else with a few taps on our phones. This wiring for immediacy makes Buffett's patience seem almost superhuman by comparison. The patience paradox shows up in every aspect of Buffett's investment approach. Take his margin of safety principle. It requires the discipline to wait for the perfect price, sometimes for years. Many investors understand this concept intellectually, but emotionally they just can't wait when they see a company they like. They'd rather pay full price today than possibly miss out, even when overpaying dramatically increases their risk. His circle of competence requires patience too. Buffett spent decades studying the insurance industry before making it a cornerstone of Berkshire Hathaway. Most investors today might spend a weekend researching a complex industry like biotechnology before diving in headfirst. The patience to thoroughly understand a business before investing is incredibly rare in today's market. Then there's his long-term perspective, the willingness to hold investments for decades while compounding works its magic. This requires watching your money grow at what initially seems like a snail's pace, trusting that the exponential curve will eventually kick in. But most investors can't resist the urge to constantly tinker with their portfolios, jumping from one opportunity to another, never giving compounding the time it needs. Perhaps most impressive is Buffett's patience during market volatility. While others panic sell during crashes, emotional discipline allows him to stay calm or even buy more. This psychological fortitude to endure paper losses without flinching is arguably his greatest edge, and it's entirely about patience. Contrast this with today's investment landscape. Day trading platforms gamify investing, making it feel like a video game with constant dopamine hits. Options trading promises overnight riches through leverage. Crypto markets operate 24/7, creating the illusion that you're missing opportunities every second you're not trading. Social media influencers showcase lavish lifestyles supposedly funded by getting rich quick through whatever investment fad is currently trending. Technology has made patience harder by bombarding us with constant market updates and breaking news alerts. Your phone notifies you when your stocks move significantly, creating the illusion that you need to respond immediately. Finance apps show real-time portfolio values, encouraging constant checking and emotional reactions. Social media feeds are full of people bragging about their investment wins, while conveniently hiding their losses, triggering FOMO and impatience. This environment makes patience increasingly rare, which makes it more valuable than ever. In a market where almost everyone is impatient, those who can master patience gain a massive competitive advantage. Buffett is playing an entirely different game than everyone else, one where time works for him instead of against him. The impact goes beyond money. Research in financial psychology shows that patient investors experience significantly lower stress levels during market turbulence. Imagine a market crash. Impatient investors are glued to their screens, watching their portfolio values plummet in real time, feeling physically sick. Patient investors view these same crashes as opportunities, staying calm because they've prepared mentally. Same external event, completely different emotional experience, all because of patience. Here's the surprising advantage. Patience functions like a muscle. It gets stronger with intentional practice. Each time you resist the urge to react emotionally to market movements, you're building your patience muscle. Each time you stick to your investment plan despite tempting alternatives, you're training your brain to value long-term results over short-term gratification. Young investors have a built-in advantage. With decades ahead of you, time is your greatest asset, if you have the patience to use it. A 25-year-old who understands the patience paradox can potentially outperform investors with far more experience simply by avoiding the emotional mistakes that come with impatience. This patience muscle becomes especially valuable during market crashes, which historically happen every few years. While everyone else is panicking, your practiced patience allows you to stay calm and potentially capitalize on opportunities. You're essentially preparing during good times for the inevitable bad times, knowing that your patience will be your greatest asset when others are losing their heads. So here's the breakthrough moment everyone misses about Warren Buffett. His superpower isn't his financial expertise, it's actually psychological. That mindset shift is everything. While most investors get trapped in anxiety spirals during market chaos, Buffett's patience and discipline create an entirely different experience. What we're truly learning from Buffett is emotional resilience that transforms how we experience money. His mental framework helps you see downturns as opportunities rather than disasters. Ready to transform your financial life? The question is, how will you build this psychological strength that costs nothing but pays forever? Your best investment is developing that emotional discipline muscle that turns